Hello traders, and welcome back to Explain the Charts. Today, on November 30th, 2025, we are taking an in-depth look at one of the most traded instruments in the world, the EURUSD. The market is currently at a fascinating inflection point, driven by a powerful fundamental narrative clashing with key technical levels. We'll start by breaking down the latest news influencing the pair before diving deep into the charts to see what the price action is telling us. The dominant theme right now is the starkly diverging monetary policy between the United States and the Eurozone. Markets are increasingly pricing in a rate cut from the U.S. Federal Reserve at its upcoming December meeting, with the CME FedWatch tool now showing an 87% probability of a 25 basis point cut. This dovish sentiment, reinforced by recent comments from Fed officials, has put significant downward pressure on the U.S. dollar index, or DXY, which has slipped to the 99.44 level. In contrast, the European Central Bank seems less inclined to ease its policy so aggressively. Recent data has shown persistent inflation in Europe, with Germany's CPI coming in hotter than expected at 2.6% and Spain's inflation reaching 3.1%. This divergence, where the Fed looks ready to cut rates while the ECB holds firm, is fundamentally bullish for the EURUSD pair in the short to medium term. However, some analysts are pointing to a much more bearish long-term picture. There is talk of a potential return to parity, or 1.0000, in 2026, citing stronger relative economic performance in the US and potential political uncertainty in Europe. So, we have a short-term bullish narrative fighting against a long-term bearish outlook, which makes our technical analysis even more critical. Now, let's look at how this has played out on the daily chart. If we zoom out, we can see the broader context of 2025. The year saw a major uptrend that carried the price all the way to a peak just below 1.1920 back in mid-September. From that September high, a dramatic and aggressive reversal occurred. The price broke through multiple support levels in a powerful downtrend that lasted through October and into early November. This brings us to the most critical support level on this chart, the swing low of 1.1468 that was established on November 5th. This low marked the bottom of that steep decline and the beginning of the recovery we are analyzing today. The velocity of that sell-off indicates that sellers were firmly in control, and that entire price region from 1.17 to 1.19 will now act as massive overhead resistance should the price ever return there. Let's zoom in on the price action just for the month of November to get a clearer picture of this recent recovery. As you can see, since hitting that key low at 1.1468, the market has been grinding its way back up. We've seen a pattern of higher lows, a classic sign of a potential trend reversal or at least a significant bounce. The price successfully reclaimed the 1.1500 level and then the crucial 1.1550 pivot zone, which was a key area of interest according to several news reports. This bullish momentum intensified last week, directly correlating with the news of rising Fed rate cut expectations. The market pushed decisively higher, culminating in a test of the 1.16 psychological level and reaching a high of 1.1614 on November 27th. However, notice how the last three daily candles have struggled to push higher, showing long upper wicks and failing to close strongly above 1.16. This suggests that while buyers have been in control during this recovery, they are now meeting significant resistance. To understand this struggle at resistance more clearly, let's switch to the 15-minute chart for the last few trading days. Here we can see the price action around the U.S. Thanksgiving holiday, where news reports correctly noted that thin trading conditions could amplify moves. We see the push on November 26th that took the price from the 1.1560s firmly above 1.16. However, throughout the 27th and 28th, there was no significant follow-through. Instead, the price entered a period of consolidation, chopping sideways in a range roughly between 1.1580 and 1.1610. This tight range shows a state of equilibrium and indecision in the market. The bulls, fueled by the dovish Fed story, are buying on dips, but the bears are defending the 1.16 level aggressively. This short-term price action confirms that 1.16 to 1.1615 is indeed the immediate battleground for control. So, let's bring it all together and go back to our daily chart to discuss the path forward. Let's recap the critical price levels we've identified. Our major overhead resistance is the zone between 1.1615 and 1.1650. A decisive daily close above 1.1650 would be a strong confirmation for the bulls. The next key resistance target above that would be the 1.1700 to 1.1720 area. To the downside, our most immediate and crucial support level is now 1.1550. Holding above this level is essential for the bullish case to remain intact. Below that, we have the major support zone from 1.1500 down to the November low of 1.1468. Now for our unbiased predictions. The short-term bullish scenario seems slightly more probable, and I would assign it a 60% likelihood. This is based on the powerful fundamental driver of an expected Fed rate cut. For this to play out, we need to see the price hold above 1.1550 and then achieve a breakout and close above the 1.1650 resistance cluster. Weakness in upcoming U.S. data, such as ISM PMIs or employment figures, would strongly reinforce this bullish path towards 1.1700. Conversely, the short-term bearish scenario has about a 40% probability. This would be triggered by a failure to break 1.1650, leading to a rejection. A break and close below the 1.1550 pivot point would be a significant warning sign that the recovery is failing. This would open the door for a retest of the major 1.1468 to 1.1500 support zone. Stronger than expected U.S. economic data, which could reduce the certainty of a December rate cut, would be the primary catalyst for this bearish move. Remember, even if the short-term bullish scenario plays out, the long-term bearish forecast of a move towards 1.0330 or even parity remains a possibility for 2026, making this rally potentially a large-scale correction. The key thing to watch for in the coming week will be the U.S. ISM data and PCE inflation reports. These data points will directly influence the market's pricing of the Fed's next move and will likely determine whether EURUSD breaks higher or gets rejected from this key resistance. That's our in-depth analysis of EURUSD. We are at a crucial crossroads where the short-term fundamental narrative is testing a very significant technical ceiling. Thank you for watching Explain the Charts. If you found this analysis helpful, please hit the like button and subscribe for more content. Finally, please remember that this video is for informational purposes only and is not financial advice. You should always conduct your own research and analysis before making any investment decisions. Trade safe, and we'll see you in the next video.